Thank you, David, and good morning, everybody. Price Headley here, BigTrends.com. Thrilled to be with you and kind of excited to contribute to this awesome event. There's with the market volatility, of course, in recent weeks and months, you see how important it is to have a method amid the madness, right? I mean, obviously, it's a news-driven market, and you see the money flows out, the money flows in. You see, just how much the market is creating both opportunities as well as needing to know how to manage risk, right? So we think it's a great time to be able to focus on a market-driven strategy using the SPY. That's the S&P 500. That's what I'm going to talk about today. The SPY, probably the most active options vehicle out there when it comes. You think of Apple, you think of Tesla, you think of other big names, but SPY still is the biggest of all because you're talking about getting exposure across the S&P 500 big names out there and how you can take advantage of them in a relatively short window of time. And when I'm trading options, I don't want to hang around too long, right? I want to be able to pick my spots and look for th systems that give me an edge. And we still at the same time would prefer to be able to be in one day and out the next. I'm not really a day trader by nature, but at the same time, I wanted to speed up what I would consider to be a faster swing trading approach to using SPY just into the next trading day. So this means that I can set up a system with 0 day trades so that even small accounts can benefit from this strategy. We're going to talk about how we like to use same week SPY options, actually just a couple days from expiration, but never hold them more than one full trading day. So from one afternoon into the next, never hold them into the final expiration day. So you don't have to sweat that melting ice cube at time so much as you get right near the expiration. So I'll walk you through that, how we use the average true range indicator as one of our tools to guide us in this approach. That's a volatility based essentially measure. And we'll walk you through how this works. And like we said, overnight, because we're going to buy it one afternoon and then hold it overnight into the next trading day. As I get things rolling, of course, just a quick reminder that the information provided in today's presentation is based on our proprietary research and it's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but we all know they also have large potential risk. We've got to manage both sides of the coin. We'll share with you how we manage both sides of that risk reward equation here today. As you know, past performance of any trading system or method is not necessarily indicative of its future results. Future results are going to vary, can be better or worse than what the history shows. But the key is you've got to have a way to consistently keep executing, and capital allocation and managing how much you're putting into each trade becomes a really important part of that. So we'll walk you through that and then see our terms of use on our BigTrends.com homepage for more information here. So one of the beauties of this method is it gets you laser focus, meaning that you're just focusing on the one vehicle, the SPY. It's tracking the overall market. A lot of people just want to buy and hold the S&P 500, right? And just hope that buy and hold works over time. Historically, it's worked pretty well, but my contention is that with the markets being kind of on the pricer end of the historical spectrum. I mean, you've seen how we can get these shakedowns here, like we had from the February peak to the April lows after Trump introduced his higher than expected tariffs. Now, of course, backing off of that, what's to say that that won't also eventually go back up, right? Everybody's sighing a big sigh of relief right now, but we know that could easily change with one bad phone call with China or whatever, right? So the bottom line is that we've got to be nimble, we've got to be flexible. You don't want to necessarily get locked in and then get stuck in a big drawdown. The S&P dropped nearly 20% high to low. I think it was like 19.8% or something like that. But bottom line is that, you don't want to endure a bear market and then you wait for your portfolio to come back and then just getting back to even. That's not how we want to trade, right? We want to be able to find low risk entry points where we can make more than we're risking. And so this is where we can really help you to, I think, get more laser focused and also very strategic about what we're going to trade and when we're going to trade, because we're not going to trade every day. It's like, I've grown up around thoroughbred horses all my life. My family's been in the thoroughbred horse breeding business and racing business. And my granddad had a saying. He said, you can beat a race, but you can't beat the races. Meaning, if you bet every race, you're going to eventually lose because there's just too much working against you. But if you can pick your spots, you can pick where you have got a good risk reward. That makes more sense. And so that's what we're looking to do here the same way. Maybe trade half of the trading days in a month at most. Something like 8 to 10 trades a month is kind of our objective here. So we call the strategy overnight spot trader, like we said, because we're going to get in right near the end of a trading day. Why would we wait to the end of a day? And you say, well, aren't you taking on overnight risk? Well, sure. If we've got a big tariff announcement or something, we're probably going to pass on that, right? But the bottom line is that, all other factors being equal, we know that okay, if we get in one afternoon, can get out the next morning, or by the next afternoon, we will never have a day trade. That's one of our first objectives is that we like to do this strategy so that you can even participate even with one contract at a time and see how these trades work. We're going to get into it. If you don't know me, I've been trading options for over 35 years. I got the trading bug while I was a student at Duke University. After graduating from there, was uh, ultimately head of research for the nation's largest options newsletter in the 90s. And then with the power of the internet, getting them into the web, said, hey, why don't I get myself into the web and launch BigTrends.com in November of 99 to share my research across the web. And across really the world. And that's the beauty of this technology, right? You can reach anywhere for anybody who wants to trade. We get a lot of foreign clients who love US markets because they're so liquid in addition to all the folks around the US and North America. But bottom line is it's always got to be about a time tested trading system, meaning that you've got a quantitative edge. Now, when you put the probabilities in your favor on any kind of a trading approach, just because you put the probabilities in your favor doesn't guarantee winners, right? If you're 60-40, it means you win six out of 10. It means you lose 4 out of 10, right? Whatever your edge is, you've got to know what that edge is. And sometimes it's not just winning percentage. Sometimes it's also, well, if I told you had a 50-50 game where you're right half the time, you go, well, that doesn't sound very appealing. But if I told you you won twice as much as you lost, that's a game you should be signing up to say when can I play and how often can I play and when do we get started. So that's what we want to get you started with is kicking off today's event with a recent winning trade example. Then I'll go into more detail on how the overnight spy trader system works. So here we are. We're literally going back here to the afternoon of May 7th. So this is just a week ago, last Wednesday afternoon. As you can see here from the market, the market had been going through this kind of bottoming process, and we had kind of gone up and broken through a little bit of resistance and come back down to it. We don't really rely just on support and resistance, but we rely on patterns of how the market is behaving based on open to close action and also based on the relative volatility of what we're going to have to pay. That's the average true range concept. So ATR, average true range, basically incorporates the fact that, yeah, guess what? Looking back over the prior month or so, the S&P average true range grew quite a bit. And so we typically like to buy options that are about half of the last month's average true range. Average true range encompasses not just a high low added up over the last anywhere from a week to several months, but basically it also encompasses any gaps, right? So if you get a gap and you get like this kind of a move where we gapped up right here, well, we're going to include that gap amount from the prior day's close as part of that bar. So that bar actually gets to be a bigger total range compared to the high-low range on that little red candle there. So that encompasses even more of the overall price action movement. And Wells Wilder developed the ATR average true range concept, which got incorporated into other useful tools like the ADX average directional movement as well. But bottom line here is that our system said, yes, this is a good spot on this retracement, this nice little flip back up to the upside there to get into those SPY calls. You can see that was May the 7th. So what did we buy? We bought the May 9th expiration. Now, one of the things I love about SPY is that it's got every single day looking forward expirations, right? In the old days, when I got started in options trading 3.5 decades ago, we had monthly options, right? Every month was all you got. And then later in the 90s, you started to see, some interest in weekly options and started to come out there actually in the early 2000s. where every Friday on some of the big names, you had an expiration every Friday. But here in recent times, one of the most popular things that everybody's raving about is zero DTE, 0 days expiration. We don't think that gives you enough runway. Even if you're an options seller, given the volatility of the markets, you can kind of get yourself in some hot water if you're not careful with not having enough time before the expiration, right? And so we like to get 2 days in before expiration and then only hold it for 1 day. So basically we're going to get in on the 7th, we're going to get into the May 9th expiration, 2 trading days later. And you again got to factor in weekends and whatnot. But we're doing 2 trading days later, and then we're going to only hold it 1 trading day later. Now notice where SPY was trading when we recommended this. SPY's trading here around, you can see just under 562. And so you can see here that, we buy a 557 call. So if you're new to options, the idea here is that you're buying a right to own the SPY at 557, right? Every single contract you purchase, one contract controls 100 shares. If you bought 10 contracts, you control 1,000 shares. We always say stay risk managed in your overall dollar allocation that you're putting into any one options trade and each options trade thereafter. So in these examples, we assume if you're putting in $1,000 maximum per options trade, and we recommend something where we get in at an average entry price of 669, well, guess what? That's only going to get us one contract controlling 100 shares because you got to multiply that 669 times 100 since the option contract controls 100 shares. You'd pay 669 bucks on average getting into that trade. So you can't buy two of those or you'd be up over $1,300. That would exceed your maximum risk that you're willing to put into a trade of 1,000 bucks. Now, we're not going to want to take that full $1,000 of loss, right? So our objective here is that we want to get a double in the next day. When we can get a double, we take it. We take whether we're trading one contract or hundreds, we take the whole position out at a 100% gain. At the same time, we put our stop loss in there at half of that maximum gain. A 50% uh, drawdown would knock us out of a trade. So if it hits our 50% loss, then we're gone. So the idea here is that okay, you're in at 669. You're trying to double that, and you can see the next day. Think of this. Think of that we're trading just under 562. We're almost 5 points in the money, right? So you've got maybe about $2 of time premium in this trade for the 669 that you paid, right? So there's more intrinsic value that gives you a little cushion there, but we also know that we need to get a pop of at least about 7 points to make this thing have the chance to double. You can see from just under 562, look where we trade the next day, right up there, about 8 points higher, just over that 570 level, right? Just into it, really. And so you can see on that day, we were able to get our double target 1338. And so when we hit that, right, because you think about a 557 call at 570, it's worth 13 bucks, right? So how do we get 13.38? There's still some time premium in that, obviously, because you have another day to go. We're exiting on the 8th. It's got to the 9th. And so that time premium will reduce not only as you get closer to the expiration, but also as you go more in the money, right? It becomes more of an in the money trade and less of a time trade. But there's still a little bit of time premium in there. So you can see that we're able to take advantage of that and ring the register, kind of regardless of what happens that next day. You don't want to ever play the woulda, coulda, shoulda game of, oh, I should have stayed in that trade, or I would have done better if I'd done something different. You've got to say, look, just what does it look like when you execute following this double, take your profit, 50% loss, take your loss. Or else, if neither ones of those are hit, we've got a time rule that says we'll get out in that last half hour of the trading day. That's that day after we got in, right? So usually we get in around 3:30 or so, no later than 3:45. Remember, the other nice thing about SPY is that the options on SPY don't just stop trading when the cash market stops at 4 o'clock. Options on SPY keep trading till 4:15 Eastern, right? 15 minutes after the cash market closes. So from that perspective, that's another aha that okay, you've got some time to respond, react. And that's why you also see a lot of companies when they report earnings. In the old days, they used to report a minute or two after 4 o'clock. But I think a lot of them are aware that the options markets are still trading in some of these at least bigger markets till 4:15. So a lot of times you'll see these companies of reporting their earnings more like 4:30 to kind of let those option markets settle and close before they create their volatility possible movement on an individual stock news item like earnings, something else to be aware of. And so you can see here, got the double. One contract made 669 bucks. Oh, by the way, what about options? What about options commissions, I should say? Options commissions are not included in these examples, but they're minimal now, right? There's no ticket charge anymore. When I first got started trading, I can recall $30 ticket charges even if you're trading one contract, which I was like, man, that makes it tough. You got to get a really big move to make that really make sense. And so now, of course, there are no ticket charges, and you shouldn't be paying more than $1 per side getting in and out of each contract, right? And that's at most. I know a lot of people are now not charging on closing transactions, which is a nice feature, or if you're more active, they're cutting your commissions down to maybe half of that dollar for more active options traders. But point being that at most, $1 in, dollar out, it's $2 round trip commission. You still pocket 667. So after the commission on this trade. But the idea is that just be aware it's a great time to be an options trader. Now, when we talk about some of the core strategy guidelines here, right? We're saying we're not going to hold it for more than 24 hours from one afternoon to the next afternoon. That way, even if we got in one afternoon and we're out the very next open, right, you're still in two different calendar days. So you have no day trades there. So, of course, as a small account trader, you don't have to worry about any kind of day traded pattern, day trader status or anything. We're not going to have that issue. Now, we're looking at price action patterns, right? We're looking across opens and closes. How are we finishing? How are we structured? And how have we kind of been hopefully building up for some potential buying interests to come, or on the other side, setting up for some downside potential too, right? We only buy the two DTE, the 2 day till expiration uh, time out, right? We don't get buy more time than we need. We don't buy less. So the beauty is that we'll be out that afternoon before the final day of expiration in any case. We will never hold into the expiration day on those daily expiration options. Now, the new trades will trigger once per day, Monday through Friday, and we'll get in before that daily bar closes. But we want to see that the daily bar pattern is essentially intact. So we feel like by about 3:45 p.m. Eastern, 15 minutes to go before the cash market closes, that daily bar is in the books, and feeling like that pattern is now in place. We should be good to go and go ahead and make sure we get in before that 4:15 options uh, prices close, right? So you got about a half an hour to get in before the 4:15 options stop trading. We want to be in there before the end of the day so we don't have a day trade problem the next day, even if we get out off of an opening gap. Now, of course, that makes it really time efficient, right? So both you and we don't have to spend a lot of time scanning for these trades. I may be noting what the market's doing earlier in the day off of some other just observances, but the reality is all that matters is what's happening there in that last half hour or so before the options close and saying, okay, now we've got our pattern. Boom, let's fire it out. We fire it out via real-time email alerts, and you can get set up for mobile phone updates through the WhatsApp technology as well. So you get a couple different ways, and I recommend both ways to make sure you're never missing anything. And we'll send you reminders on not just entries, but on every exit, so you're never left hanging. Now, that scanning makes it something where we'll get plenty of trade frequency. Like we said, we're looking for about 8 to 10 trades a month, typically trades that can double. Because we're not paying. One of the reasons these can double, even on an option that was like a $6.50 option or more, was that we have the daily range that's been picking up in the S&P, and also we have the fact that we're not overpaying for time premium, right? Some people would say, well, why not buy more time just to give yourself a little more cushion? But my view is that if you buy more time, you're making it harder on yourself to get a certain profit target. And so we want to buy the right amount of time, but not more time than we need, right? So we believe the 2 day expiration, 2 days expiration is really a sweet spot here, knowing that you're not going to hold it for more than 24 hours from one afternoon to the next. So we get a lot of bang for our buck, a lot of leverage for a relatively small investment. Now you say, well, I showed you an example where we paid almost 670 bucks getting in. That's not a cheap option per se, but it's still a great bang for your buck compared to the cost of the SPY, right? SPY's trading right now at 587. So when you think about that, you think, well, if I bought 100 shares of SPY right now, 58,700 bucks, just under 60 grand that I'm putting in to control 100 shares. You're controlling that 100 shares on average for just a few $100. You can see our average contract price, looking back over the past year or more, is under $3, $2.85. That means that on average, if you're putting in 1,000 bucks a trade at maximum, you get three contracts for just under 900 bucks on average per trade. We will get out of the trades the next trading day at 3:45 p.m. if we have not already hit our profit target or our price stop. So this makes sure we don't take it into the final day expiration. It's not just volatility that we care about, it's also time erosion, right? What happens with time value, time erosion, is that it will speed up. You'll get more and more time erosion as you get closer and closer to the options expiration at that 4:15 point on that day of expiration, right? Wall Street time. So the bottom line is that, yeah, we don't want to deal with that kind of speeding up. The heat in the kitchen's getting too hot for us for that final day to mess around on the last day. We can get our work done, get in, get out, and avoid that possible incineration of the options time value in that final day. So you look at this and you say, okay, our specific setup patterns could fall actually into one of five different categories. In our view, four of those categories are potentially tradable price action patterns. And then if it falls in that other category, that fifth one, we won't pull the trigger. The key is we're looking back in the past, knowing we cannot guarantee the future from the past, but I tend to believe these patterns are a lot like people where, people have unique personalities, but also a lot of times those personality traits transfer over to and dependable people stay dependable, and non-dependable folks tend to stay non-dependable, right? It's one of those things where you can kind of learn what to expect with these patterns as well. So the idea is that, and they often say that in people, what is it, 87% of past behavior will predict future behavior. I like those odds, right? So the idea is that, we're looking for that same type of thing, even if we're playing the odds, and even if it doesn't pan out on some of those cases, we know that we're putting that edge to work for us over a longer period of time. And then we've got a method to the madness. We're basically taking what seems like the chaos of the markets and turning it into an orderly set of patterns that you can trade with confidence, right? Because you've got to have that confidence and belief that you can have an edge, and you can then just focus on execution. That's why a lot of subscribers come to Big Trends now in our 26th year and counting, is because of the consistency of being able to execute a system. They know that there's going to be winners, there's going to be losers. Then you've got to know that too. But the idea is that you've got to position yourself for, what's my plan? I'm not just going to be reactive to, oh, the market's up off the open, I better buy calls. No, I mean, you've seen a ton of times where that still fades. I mean, even off of the rally at the start of the week on the China news, right? I got a big gap up, and then it was basically mostly a pancake of a day. The rest of the day had a pull back off of that open, had a little grind back up, but essentially was pretty flat off of that open, right? Most of the action happened from the close to the next day's open. We see that a lot in the SPY, so we want to make sure that we take advantage of that. And don't just react on the next day's open, but the prior day headed into the close. Now, I can't give away my exact settings here on this introductory event, but I can tell you that when you become a subscriber, I've got a great starter special for you in a little bit. But the idea is that we want you to learn the system. So you get the settings and rules as a subscriber. All we ask is that you don't be sharing that out there on the webosphere, right? We want to keep our edge strong within our paid subscriber base. So bottom line, though, is that what we're looking at, the current bar's range, like we said, looking at that high-low range within the average true range, which, remember, the average true range is looking back over a period of time to identify, do we have momentum or do we not have momentum? So obviously, you want to see patterns where you're set up for not just existing momentum, but potential follow through off of that pattern, right? So the key is that, if you tell me that the SPY tends to move up, 10 points, and you tell me, well, we're already up 8 points, well, then my risk reward might be upside down buying SPY after it's already rallied those 8 points. So part of it is kind of looking at, does the pattern suggest that we've got more potential relative to the risk, right? Everything is risk versus reward, not just flat, 2 points of reward, it's like, well, if I've got 2 points of reward and 4 points of risk, that's not going to make for a really attractive system the way we're doing things here. We need more reward relative to risk. So we're looking at price action, we're looking at individual candles, we're looking for bullish or bearish confirmation based on the way that the patterns are setting up. And like I said before, just because it's a green bar, meaning that we're closing above where we open, doesn't guarantee that it's going to be bullish in the future. And same way with the red lower close compared to where we open, that's what makes that candle red. Let's look at the charts a little bit more here. Here's an example, right? Red candle. But remember what I said before? I said including the gap here that you've got, the prior day's close is back down back here, right? So that gap up to the open, and of course you see it filled back in somewhat. This whole gap area here, put a block around that. That gets encompassed into the total range calculation there, right? So that's actually almost not quite half of that total true range, but it's probably at least a third of it, right? Maybe even 40% of it. So the idea is that encompassing those gaps along with that is important, and you can see sort of changes your perspective on where was the close within that range, the true range, including the gap. The close was not so bad compared to where we had been the prior day, right? It looks bad because of that red candle marker there, but yet our data says it's actually a positive in the bigger picture breakout that it had that day. So we actually picked it up there into that brief little retrace, and the SPY's trading just over 535 here. So at 535, we're buying a 530 call. Maybe it was almost 536, but 530 call, even just for round numbers, if it's 5 points in the money, that would be 5 points intrinsic value, and thus the other 414 would be time risk, right? You can say, well, why do we buy such an expensive option? Because the overall recent average true range calculation was quite a bit higher because of the April downside volatility that we saw after President Trump's April 2nd Liberation Day press conference, which shocked the world with his proposed bigger than expected tariffs. Obviously, now going back on those and looking like a negotiating ploy. We'll see if that comes back into play for real or not. But the bottom line is that you can see that was the start of a pretty nice uptrend, we all know in retrospect, but our system picked it up in real time to say you want to be buying that, not fading that, right? Part of it is also I think of the Jesse Livermore quote from one of my favorite trading books of all time, Reminiscences of a Stock Operator, based on Livermore's life more than 100 years ago. And these psychological principles have not changed. But he said there's not two sides to the market. There's not the bull side and the bear side. He said there's just one side to the market, the right side. Okay, so we want to be on the right side of the market when we structure these trades. Just because we're on the right side again doesn't guarantee that every trade is going to work, but it means that you're putting the odds in your favor here. If you're on the wrong side and you're buying into the media negativity and the general negative sentiment that's out there and trying to fade every bounce, well, then you'd be getting creamed over the past 2 or 3 weeks, right? So the idea is that it's important to align yourself with what the market is telling you for feedback here. Now, this one's kind of interesting because even though we got a great move, why didn't we get our double target? Partly because we had to buy such an expensive option, right? But we did that because we thought it was the better choice because of the um, expanded average true range that we'd seen. We try to usually make our options entry price equal to about half of the recent look back average true range overall point move that we've been getting on average looking back over multiple weeks. So the idea of this is that, okay, we're factoring that in and saying it's better to buy a higher priced option and get some good intrinsic value because you know what happens when you get an expansion in volatility because of that average true range expansion, guess what happens to your option premiums? The at the money and out of the money options get more expensive. The volatility going higher will boost the total amount you have to pay. All other factors being equal except for volatility, right? So the way to manage that and to moderate that impact is to buy more in the money and reduce the amount of time premium effectively that you're paying as a percentage. Here we're paying less than half of our option premium as time. If you're buying an at the money 535, 536 call, you would be paying 100% time and be paying too inflated of a price in our view, too much risk compared to reward in those types of scenarios. So we moderated that. So we didn't get our double. It's the I'm giving you the long version here, but we didn't get our double, but we made 73.3%. So again, if you're putting $1,000 in, I want to get you one contract in for $914. You see, we're out that next afternoon. We're sending our alert out by 3:45, and as it turns out, we're finishing near the highs of the day. Right, we're less than a less than a point, maybe even almost a half point off of that high right there. But the point is that we're out at 1584. We're booking $670 on the 914 we invested, right? So we're very happy with that. There's no complaints. It's still a very healthy trade. And so the idea is that it's just about stacking the odds in your favor and then doing the right thing in terms of the option selection. So we've got some very specific rules. When you become a subscriber, you'll learn our rules tied to how much premium we want to pay for a 2-day expiration option based on recent average true range calculations on the SPY. Now, here's an interesting one because it's actually looking at the other side of the coin, which is you can see when the market was starting to come down there in early March, we got a bounce. But again, you've seen we'd kind of broken to the downside, got a little retrace. But notice our system said that that's not a new uptrend. It actually said that's actually a good risk reward entry on the put side. Remember, if you're buying a put, you're betting on the downside. You're owning a right to sell the SPY at that fixed strike price of 581. You can see we're closing that day in the neighborhood of about 583. So we're only about two points in the money here, and we're paying 414. So it's about a 50-50 time and intrinsic value calculation. That was March the 5th. So we're getting 2 days out that was a Wednesday. We're going out to Friday, March 7th. And you can see we get the benefit the next morning of a gap down, right? We had finished at 583. Look where we opened. We opened around 576. Happened to be about where we closed, 575 and a half maybe. But you can see here that we're cashing it in at the double, right? Because 581 goes down to a low there of about 574, about $7 intrinsically at that point at the lows that day, that next day on the 6th of March. And you can see that you still have another day of time too, right? So there's another more than a point of time value still in that option because you have more than 24 hours left before the expiration. So, again, it just shows you that, it can work out real nicely. That ended up making us $828 in profits because, of course, if you're paying 414 and you're investing up to 1,000, that gets you two contracts in for 828. You ring the register at over $1,650 closed out and make the 828 gross before commissions. Again, two in, two out, $4 maximum commission, still make 824 net. So here's another one where we were climbing up post Trump election back there in early December, and you can see again, you saw the climb happening. You saw the building of positive momentum. We were getting some nice higher close action there as well. So we're saying, yeah, there's a lot of positive momentum building there. Our system picked it up as that was a good sort of a consolidation candle, if you will. It finished positively. You see, it's kind of right in line with about the prior day's highs and lows. And that doesn't worry us if we catch our breath a little bit on our way up. In this case, about 604, we buy a 2 point in the money 602 strike call 2 days out to expiration. We're only paying 277. So these options were notably cheaper in comparison to the recent options I've been showing you, right? So because the average true range over the past several weeks had been relatively moderate, right? We've been rallying, but it hadn't been just like really overly volatile, been fairly orderly. We're able to buy about $2 in the money and only pay 277 rather than like a $4 option like I was showing you in the last couple of months. So that was a lower volatility, lower average true range look back period. And so we were able to, in our view, go with a relatively cheaper option and still one that had a pretty good risk reward ratio here in our view. You can see, as it turns out, we catch the upside gap and the continuation the next day. And it looks like a huge move on that chart, but it's only going from 604 to 608, right? So when you think about that, moving 4.5 points or so, maybe at max, is that, you say, well, that's like 2/3% on the index, right? And you're saying, well, how would you expect to make a double on that? But yet, because the options were so reasonably priced, and we catch some of that range expansion, some of that continuation trend move, we do get the exit at 560. Think about it again, a 602 call at 608, it's worth $6, right? We're out at 560, 102%, and saying thank you very much. As you see, it goes up a little bit more and then it rips back down a few days later. So again, this is the power of kind of taking the bird in the hand, being very happy with a double in 24 hours when we can get it. If we don't get it, we don't sweat it. We know there's a plan. But like I said, we have to have a plan if we don't get our double. And the two plans are one, we take the stop loss of 50% if it's going the wrong direction, or we use what we call the time stop, which means we got in at 345 one day, we'll be out at 345 the next day. Like this chart shows you actually two of those where we're getting out that next afternoon. You can see coming into this is about a month before the election last fall, where you see that we were kind of basing out, but coming up with some good momentum. We were just over 573. We bought the 573 calls with a couple more days to go for 317. So this was more near the money to at the money, and you can see we're looking for it to go to six, but that would imply that it needs to go up to about 579 and change. Intrinsically, you see it gets to about maybe 577 and a half, finishes about 577, about $4 intrinsic. We get out at 485. So there's still time value there, right? It's a 53% gainer. We're not complaining. But, we see we were maybe another point away from the highs of getting our double target, didn't get it. And so we just get out and send a follow-up email instruction to you to say, okay, we're getting out. Let's go ahead and hop on out here before that subsequent day's close after we got in. Then we get a nice little consolidation here, nice little positive finish from that little, you can see consolidation action happening, that little wedge starting to form here. It's finishing that day around 576. We're buying a 575 call, about a point in the money. We're paying 303. So you're putting $1,000 in maximum. That'll get you three contracts in times 303. It'd be $909 invested on three contracts. What do we need to happen? Well, that 303 needs to turn into 606, which implies it gets just over 581. You see, it got to 580.33. Got close, no cigar, but you can see finishes back down a little bit, 579 and a half. So in theory, it's worth like $4.50 intrinsically. Notice we've got another three-quarters of a point of time value still in that option when we exit there at 345 that day at 74 and a quarter% gains, right? So again, these are healthy gains, but not double. So that it can happen that time stop has to kick in. Now, interestingly, I said we might expect to only trade about half of the day. So you can see overnight spy trader has been finding an average of up to 14 new option trades a month. I like to promise more like 8 to 10, like two a week is I think a healthy enough expectation. If we happen to get like three a week, that would be great. But I want to make sure that you're not buying it just for quantity of trades, but you're buying it for quality, right? We always put quality as our very first focus. And then, of course, if the frequency is there too, with plenty of opportunities on the quantity side, great. But if it's not, we're not going to force a trade just to try to get out a set number of trades, right? We want to always make sure we're well positioned here. So you can see here's one where SPY had rallied, then you saw a little settle, then you saw some stability forming here where we closed above where we were the day before. So it's a positive close there. We're just over 579 and we're buying 579 calls you see for 265. Can't quite get four contracts at $1,000, so we get three contracts in on that type of a trade for almost $800. As you can see, the next day we're buying a 579 call for 265. We want it to turn into 530. That means it needs to get to like almost 585. And you see it got close. We got just a hair over 584 and then started to come back down. But the key was that, yeah, that actually did get its double. Now, this is the reason I show you this one is that this is why you don't hold and hope, right? We're able to get it, like we said, 584 and a half. It's about right where it got to at the high with probably a little bit of time premium. Probably didn't sell it exactly at the high, but close. But the key is that, look, then it gets this big reversal back down. And if you were sitting there holding and hoping, you'd be back to slightly under where you bought the spot the day before. If that happens, guess what? You're going to be in a losing position if you've hold and hope. Whereas we've already booked our double and gotten back to the safety of cash on the sidelines. The person who's saying, "Oh, I think this can go to triple or quadruple," well, they're now in a loss, and so that's 100 percentage points gone in that quest for building your portfolio, right? It's like you got to think of it like you're building your house brick at a time, you're building your portfolio brick at a time, and we want to be continuing to lock those down and not just hold and hope that we can get there faster. Rather, take that, lock it down, and keep adding to your portfolio's growth. Another example on this one, this was an unusual one because it was something where we've also got a pattern in there where when you've gotten enough of a spike on the downside, you say, well, gee, the momentum definitely looks against the SPY right here with those big red candles. But our data said that actually it kind of checked the boxes that we'd seen kind of maybe a flush out, we thought, on the downside with that type of excessive past week's worth of volatility on the downside. We were finishing that day near 540, maybe 540 and a half, and we said, let's buy the 541 calls. Again, when you've seen that kind of pullback, you know you're not going to be able to probably go too far in the money because the volatilities are going to be up. So in this case, we bought the near the money 541 calls, paid 342, wouldn't quite get us three contracts on 1,000, so we'd get two contracts in for 684. And you can see we're targeting that double. Think about it, a 541 call, if it's up to 684, that would imply an intrinsic value up around just under 548. That's right where we traded to at the highs. We traded to right into 548 and then backed off close 546 and a half. Up near 548, we locked it down, took down the 100.29% winner and said, thank you very much, Mr. Market. We will book the double and run. Now, what does a loser look like? I mean, there's going to be losers. Here's one where, it looked like everything was set up for a nice little pause that refreshed here. We thought that this SPY was ready to run to the upside, so we're trading in this one just over 584. We buy the 583 calls, 266 to get us three contracts in for about, in this case, $800. You can see 266. If we go down to 133, we got to get rid of it. Well, look what happens as it trades down here during that day. It's gone from 584 down to about 580 and a half. So while it does eventually snap back by the end of the day, we have to take our stop out at that 50% give back uh, and say goodbye. Take the halving of your investment value there and take the hit, move on back to the sideline. So sometimes that'll happen. Obviously, we want to minimize that. We want to make sure that we're not having too many of those fake outs, right? But sometimes you also get the benefit of gaps past your profit target. Okay. So, when you can get that, that's just a windfall and you don't do anything different. You say, okay, I'll take a double or more. If it give me more, I'll take it. So in this example, it was quite a bit more. And this is an outlier. It's not something you should expect that often, but it can happen. And so we wanted to show it to you. Now, in this case, notice SPY had come well back up. And you can see in this example here that we're looking at a situation here where it has that little pause. We're finishing the day near 440. We're buying the at the money-ish calls. And you can see in this case, we entered at 245. That means that on $1,000 invested, if you're paying $245 a contract, you can get four contracts for just under that $1,000, total of $980 before commission. And the idea of this is that, okay, you get four of those contracts. We're trying to take the 245 up to a double at 490. So we'll send you a reminder that night, the next morning before the open. Hey, we thought that there would have been uh, a, a in this case an exit in here at 490. Notice though, instead it gaps way up, right? We're finishing near 440. Next morning, we're up about 7 points quickly right off of that open here, right? So you look at that and you say, okay, so that 245 and that quick pop up almost 7 points the next morning picks up four dollars and 30 cents out of that $7 move, right? That's pretty good for the out of the money um, or near the money 440 calls going to deep in the money, right? And it kept going a bit too, right? So we actually, caught a really nice 176% gainer here. So that's fun when they happen. Obviously, it kept going a bit intraday, went all the way up there to 450. But we're not trying to get cute and say we could have made even more. We're really looking at it more from the perspective of, okay, what's the right thing to do at any point in time, right? If we do the right thing over time, that will definitely enhance confidence. It will enhance the uh, the whole process here to help you take full advantage of these outliers and say, hey, outliers happen. It could also gap more than the 50% loss. So you got to keep that in mind too. So outliers can happen in both directions. But the beauty is, of course, you can make theoretically many multiples of what you buy an option for. You can't lose more than what you put into an option at the worst case. So what we've done here for you is we've set up a pretty cool trial offer that I just approved, and it's only going to be available till midnight tonight because my subscribers, I've got a lot of them who paid a bunch more than what I'm going to offer it to you today. But David and his crew have been good to me, and I want to definitely help pass that back over to you all. So have you try it out and let the system prove it to you rather than just taking my word for it. So these are real-time trade alerts. We never leave you hanging. When we get a new signal, we'll send it out through the real-time email. And like I said, you also get follow-up instructions on how to set it up as a text alert to yourself as well. I recommend getting both so you never miss a trade signal. So what I don't believe really a month is enough time to try any kind of a service. I think you need to see it through a variety of market conditions. And so what I've set up here is a 3 month super markdown, super savings special for you here. It's not just a give you a fish trade alert service, though. It is also about helping teach you the fish, helping you learn the system. So we give you a lot of education here. The education starts with access to the overnight spy trader settings and rules sheet. So in addition to 3 months or 90 days worth of trade alerts, you're going to be able to review the rules, learn the settings, learn how it's working. I also personally do our weekly video coaching and update training. So basically you can have me explaining what we saw this past week in the overnight spy trader system and also what other things we're looking at for the week ahead. So we kind of keep you constantly in touch and in focus there. Um, and so, in addition to that, if you've ever got any other questions, you can always, we give you a dedicated email address to me and my analyst team. Something that's not publicized on our website, but basically a separate email. When we get those, we know, hey, it's a paid client asking a question about a trade. Let's make sure we get you a prompt response so that you understand it, and then we clarify and answer your question, so it gets you taken care of there. So that's a dedicated research-based email that you can email my team and I anytime you got a question. If you're adding this up off of my website, buying overnight spot trader a month at a time, it costs you $297 a month. So multiply that times 3 months, you'd be at $891 in value and outlay of what you would pay. I'm going to save you a bunch on that here today. What I'm going to do is I'm going to mark it down from 891 and say try it with my thanks for trying it for just 177 bucks. The idea being that at 177 bucks, one of these trades, even if you're trading one contract, I showed you a number of times where one contract could have made you, one was 670 bucks on a contract, another contract, the $900 one made you about another 600 bucks, right? So you can easily get a great ROI on your $177 investment very quickly off of one winning trade in this system. I do expect, like I said, in 3 months that we would generate at least 30, probably at least 25, but probably more like 30 signals. So you can do a cost per trade off of that. You can also do a cost per day. Basically, we're giving you 90 days of access for less than $2 a day, just 177 bucks here. So this is a special page that we set up for you here. It's members.bigtrends.com, and definitely pop in any questions. I'll seek to answer those here in a minute too. But I want to show you this page here and then come back and pick up some questions here. So when you go to that page, let me just show you how this works. We've already taken all discounts and promo codes into effect, right? We've taken 891 bucks down by more than 700 bucks to just 177 bucks on that page. So it's members.bigtrends.com/spy. Also on that page, you can see it's got our customer service email. Clientcare@bigtrends.com is the email address. You can make a note of that, copy and paste that into your, whatever file you might keep on like how to contact us. Also, you can call us at our toll-free 800 number. That's 800-244-8736. We have representatives standing by during market hours and during regular Eastern time business hours. But also, if you can't remember that number, just remember it's also 1-800-BIG-TRENDS. If you spell that out on your phone, it'll get you to us at 800-BIG-TRENDS. So that's getting you access to not just the trade alerts, right? So that's going to give you the 3 months worth of trade alerts, next 90 days. It's also going to give you access to the rule sheet, access to past video training I've done, and a whole lot of additional ongoing support anytime you've got a question with my analyst team and I. So you can see you can do your purchase there on that page. When you do it on that page, make sure you get your email in right. That's the first big way we communicate with you. We'll send you follow-up instructions on things like how to set up the text alerts and things like that through the email. So make sure you get your email right. Of course, make sure your billing address matches your street address. Sometimes people contact us say it's not going through. If those don't match, it might not go through. So make sure you just kind of make sure those things match. It's a secure page. You can get your payment info in there, or you can click through on the PayPal link. You would just read our terms and conditions of how we've done business for now in our 26th year and counting, and how we take care of you. Um, Answer any questions there, and then click on that. And then you can also go to PayPal, right? PayPal is so easy, just a few clicks. You click through to PayPal, you sign in, you choose your money source, click, 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 and you're locked in 3 months for 177. By the way, this is not going to auto renew. So I want you to just try it for the 3 months. I believe you're going to be so happy that you'll be willing to pay more typical retail prices 3 months hence. So consider this just my 3 month kind of uh, bargain look at letting the system prove it to you, not just taking my word for it. So, like I said, where do you go for that? It's that bottom link right here. And remember, it's not a www link. We want you thinking like a Big Trends member when you get signed up. So it's members.bigtrends.com/spy. That members.bigtrends.com will become your member site portal where you can log in. You'll get a dedicated um, password to go with your username, and basically you'll be able to then log in, see the updates and all that. But of course, we'll send you through your email box, and if you set it up on your smartphone too, we'll send you all those updates through email and text as well. Now, in terms of the frequently asked questions that we get, what type of strategy? Just summarizing, it's not anything complicated. We're not doing any spreads. We're not doing any kind of naked option sales or anything. We're just keeping it simple on the front end, buying a call when we're bullish, buying a put when we're bearish. Typically at the money. I've showed you some examples that are a little bit in the money or could be a little bit out of the money. It depends on the market environment and what our data says is the right type of options price point to pay relative to the kind of volatility that the S&P has had in recent weeks. So we basically adjust that, and so it's never going to say we're just going to buy the $5 option. That would be way too fixed and way too rigid. We want to be much more adaptable to, okay, in higher volatility conditions, you should expect us to pay a higher premium and try to get it a little bit more in the money to reduce our volatility risk. But at the same time, in lower volatilities, you should expect that we'll be able to buy some cheaper options, get even more contracts. It's all relative to the kind of environment we're in. How we get the trade alerts, like I said, real time via email. You can also get it as a text alert on your smartphone through the WhatsApp technology. Will help you set that up when you become a subscriber. So when do we send these new overnight spy trader or OST signals? At 3:45 Eastern time. I know for a lot of people that seems like not much time to act, but we want to make sure that we're giving you enough time with the options not closing until 4:15. It gives you half an hour, but also we want to get enough time to make sure that we're close enough to the end of the day to make sure we've got the right signal confirmed and not have overreacted earlier in the day and then seen the market reverse and not do what we thought it was going to do. Right. So that's important. And we'll guide you through that. When are the trades closed using the time stop? If we don't get our 100% profit target or we don't get our 50% stop loss, then we will get you out the next trading day at 3:45 p.m. Eastern. Okay, so that's important too. We're averaging 14 trades a month, but I'm saying don't expect that. I'd say 8 to 10 would be a more reasonable expectation. If we deliver more than that, great. But no, quality is always our first objective here, and then quantity should follow. Will there be any day trades? No, not any day trades because we're getting in right before the close, and then we're looking for a meaningful, usually about a 1% type of a move in SPY to potentially get us to our target the next day. So you get a 1% move, you make a double, you've got the theoretical 100 to 1 leverage of the options working for you there. Remember, our recommended entry price for an options trade on the SPY trader system was just $2.85 going back to November of 23. So we're talking about the last year and a half now. That's less than $3 a contract or $300 to control each 100 shares of SPY, meaning that put $1,000 into each trade, that would mean you could get about 3 contracts on average per trade. It could adjust depending on the price that we do. What are the extra bonuses that you get today? The weekly video training from me, that's going to be every single week. We'll post an update then to your member site access. The settings and rule sheet, which you get, so that way you can learn the system while you're earning from it. And then a dedicated email to me and my analyst team anytime you've got a question. So, and just a reminder what one trade can do for you. Obviously, we know that past performance never guarantees future results. But you say, well, hey, what have you done for me lately? Well, just here a week ago, we were buying the SPY calls. As you know, market has ripped higher. We caught the next day rip from our 669 entry. We closed it the next day on that just over 1% rally in the SPY and made a $669 profit on just one options contract. If you're putting in $1,000, it would only get you one contract, and that's okay. One contract is acceptable, especially when you can see it double in that next trading day. And if it's at stop, fine. That can happen too. The point of it is finding the patterns, finding the action points, and then saying, okay, now it's your time to take action. And like I said, what are you getting here? It's not just a 1 month trial; it's a 3 month look at a really attractive price point. Like I said, where one trade can easily pay for this multiple times over. Usually you'd pay $891 over the 3 months off of my website with all the educational bonuses, but we're taking that 891 down by some 80% here to just $177. That's less than $2 a day over the next 90 days. You're getting access to the trade alerts. You're getting access to my team and I if you've got questions. You're learning the system with the rule sheet and then getting the weekly video coaching and training so that you're getting that support and that constant reinforcement so you can truly build your confidence up in what you're doing and having the laser focus to trade just the one vehicle SPY. I know it can be incredibly stressful when you're trying to jump around and do way too many things. I would rather you not be a jack of all trades. I'd rather you be a master of one particular trading symbol and vehicle and approach. And doing this for the Synergy Traders SPY event here, taking advantage of the SPY on this Synergy event, I think is going to be a great focusing point for you to really get zeroed in on these opportunities. You go to members.bigtrends.com/SPY. I want to make sure I haven't missed any questions. So if I have, David, let me know. I haven't been able to follow the chat here. Let's see. Any jump out at you, let me know here. Typically 2 trades a week, says TFT. Yes, 2 trades a week is my expectation. If you get three, great, but I'd rather have you focus on quality, not quantity. A subscription after 3 months, ask Lancelot. I think you're going to be willing to pay more at that point. There's no auto bill here, so know that just try it for the 90 days, and then we can talk and see that you're satisfied and definitely see the power of the system. Can they be bracketed into a platform? I mean, basically, we're just calling out the alerts for you. You can actually, of course, as you learn the rule sheet, you could set it up as a systematic thing on whatever platform you want if it gives you that coding ability on the platform. Richard, we're not doing any E-mini options here. Obviously, we're not doing SPX. We're just focusing on SPY. So this is something you can do in your stock options account. It's just basically using the SPY ETF, which is the most active vehicle out there today. So, can you put stops or bracket orders also, RMS? Yes, you can do a what's called an OCO order, which means one cancels the other. So you could put your 100% target and your 50% loss in together as an OCO order. So we're not using market orders where you're putting a limit out even on those 24-hour later exits. So get out at this price or better. So we like to use limits rather than market. So got a lot of good questions there. And then, of course, know that we'll help answer your other questions as you become a subscriber here. I'm going to hand it back over to David since I'm out of time. Thanks for having me, David.